The one statistic that keeps the mainstream media pretending the economy is fine is jobs statistics. A couple recent reports are making those numbers look more and more deceptive. The other day, the widely watched JOLT survey measuring job openings and job quits came out, and it was, according to Zero Hedge, bizarre. Meanwhile, the Bureau of Labor Statistics massively, really comically, revised their most recent real hourly compensation estimates, that's the buying power of your salary, from a 0.7% annual gain, weak but positive, to, get this, a drop of 4.7%. That's an astounding revision. And real compensation normally moves 1% or 2% per year, and here the BLS was off by 5.5%, meaning either they are completely incompetent or the original numbers, the ones that got reported in the press, are intentional lies. On the JOLTS, according to the finest statisticians governments can buy, the number of job openings soared by almost 360,000 after over a year of declines. This was roughly 700,000 higher than Wall Street consensus. In fact, it was higher than the highest Wall Street estimate, suggesting that either Wall Street is getting really, really bad at predicting jobs numbers, or that something odd, bizarre perhaps, is going on with the numbers. Arguing for Team Bizarre was the completely contradictory numbers in the other half of the report that job quits tumbled to the lowest in 2 years. Now, falling quits is widely interpreted as people being nervous about finding a replacement job. So if openings soar 700,000, beating even the most coke-fueled Wall Streeter, you do not expect quits to fall to the lowest in 2 years. Now, it is entirely possible that government statisticians try their best despite institutional incentives to lie, but they can only see what their tools show them, and JOLTS, like many government numbers, is calculated by sending out questionnaires and praying that companies bother filling them in diligently and truthfully, despite having no particular reason to waste their time. Thing is, this response rate has been drifting down for a decade, but it absolutely plunged during COVID, hitting just 31% from 70% a decade previous. Perhaps because companies were short-staffed and had more pressing priorities than giving government statisticians raw material for their statistical fantasies. The problem, and this is Statistics 101, is that if your sample changes dramatically, let's say dropping from a 70% response to a 31%, you have to stop everything and thoroughly understand what happened. For example, if the struggling company stopped responding, then you're only reading the growing companies, the companies that are hiring. Or if some companies are more likely to respond, say government contractors, then you're not measuring jobs at all. You're just measuring government spending. Fixing the sample is hard work and costs budget, and it is hard to see why the BLS has any interest in debunking jobs numbers that are helping the administration who, after all, determines their annual budget. And so right on cue, we've got 2 more jobs reports this week, both looking like blockbusters at almost 50% above Wall Street estimates. The market did not react to the first, suggesting the smart money no longer believes these statistics. If that continues, it leaves us with shadow indicators, things like credit cards and household budgets, and even less confidence whether government statistics are even trying to tell the truth. Okay, we'll be watching. See you next time.